to talk about an article I wrote a long time ago before on ETFs, tax loss harvesting and wash sale rules. With the way the market has behaved so far this year, I figured it was worth talking about this great tip to save a bit on taxes. Let's start with the wash sale rules. The wash sale rule was established by the IRS and basically says you cannot sell an investment holding, recognize the tax loss, and then buy a substantially identical holding 30 days before or after the sale of that position where the loss is recognized. Basically, if you have a loss on GE, you cannot sell it and then buy it within 30 days on either side of that sale. The IRS will even look beyond you as an individual, so it can consider the seller's spouse and any entity the seller controls. Unfortunately, so if I sell my GE stock at a loss, my wife cannot buy it in her account within 30 days. The penalty is you take the loss and you add it to the purchase price of the new position to create that new cost basis. Now, I love me some ETFs for various reasons. First, you cannot beat their low cost. Two, I'd rather try and mirror the market than try and outperform it, because the odds are you're going to end up underperforming it instead. Finally, because there's a nice gap in there where ETFs are not considered substantially identical for wash sale rules. Now, a few years ago, I learned a trick from an institutional money manager. They had two lists of ETFs for their clients' accounts. I asked them why two lists, and they explained it was so they could do tax loss harvesting, stay fully invested in the market, and still stay compliant with the wash sale rules. My response was, tell me more. Now, each list covered the main asset classes. They covered large, mid, small companies, both value and growth. It also included international, emerging markets, real estate, and all the major bond categories. However, the difference between the two lists was the parent ETF company was different. For example, maybe their A list had iShares for their large, mid, and small ETFs. However, on the B list of ETFs, it may have been Vanguard. They explained to me that while on the surface, it would appear that two large cap value ETFs were similar as they were covering the same underlying index, because the ETFs were from different companies, they were not considered substantially identical per the IRS, at least not yet. Because of this fact, they were running an extremely tax-efficient portfolio and constantly harvesting tax losses when the opportunities arose. At the same time, they didn't have to worry about being out of the market waiting for that 30-day wash sale rule to expire. This was a pretty radical stuff I learned. It's something I've incorporated into my own practice. Now, is this something you can do on your own? Absolutely. Yes, it is. Is it something you need to be very careful with so you don't run afoul of the wash sale rules? Yes, that as well. So stay on top of things, because I have to believe at some point in time the IRS will declare ETFs substantially identical if they're covering the same asset category. Additionally, I recommend you're not doing too much tax loss harvesting, because trading costs may eat up your losses. Now, you probably know more about how you can use ETFs for tax loss harvesting and not violate the wash sale rules than 80 or 90% of advisors out there. And I'm not exaggerating with that number. And remember, if you're going to follow this method, let's be careful out there.